They looked at what are the main causes of failure in startups. They were surprised by their own finding, which was that in 70% of the failures they looked at, a significant problem of the company was that they'd raised too much money. And essentially what that meant was before the startup had properly validated what they were working on, they raised a ton of money and invested a ton of money in growth and in hiring and technology and development. And then when it was wrong, the company just explodes.
Welcome to The Peel. I'm your host, Turner Novak, founder of Banana Capital. Today's guest is Dan Gray, head of insights at Equidam.
I really enjoy shedding light on great research around VC that has really important implications for investing, but doesn't get the attention it deserves.
If you're a technology and investing nerd like us, you'll love this conversation, covering everything Dan's learned reading dozens of academic papers on startups and venture capital.
The definition of a startup is surprisingly not simple.
We talk about what the research says, what the dangers of premature startup scaling.
What should happen through a startup's life is as they develop, the risk slowly goes down. You end up raising these huge rounds and your risk shoots back up to the top again.
The importance of origination stage investing.
You get the same uplift in productivity from that investment if you just move the current allocation earlier than if you double the amount of capital.
The concept of startup catering and why so many startups look the same.
It's probably my favorite paper on VC.
The role of mega funds in the ecosystem.
For all that those dollars are currently allocated in the VC bucket to these LPs, it's probably displacing PE money.
What the research says about concentration versus diversification in the venture fund.
A more diversified VC is more comfortable taking more risk on a per investment basis. So they'll go out and back things that might seem crazy to other people more often.
What VCs get wrong about pattern matching.
Not only do they lead to bad investments, but they lead to missed good investments.
And why pivoting is more valuable than you think.
High-tech startups are actually more likely to succeed after they've had one pivot.
Before we jump in, a reminder that I publish new episodes of The Peel every week, exploring the world's greatest startup stories, just like this one. Check out the back catalog of over 100 episodes, including last week's with Dan Fader, who runs private market investing at the University of Michigan's $8 billion endowment. Now, let's talk to Dan after a quick word from Harmonic and Ramp. If you're running a finance team, you know how much time gets wasted on expense management. Chasing receipts, categorizing transactions, waiting for expense reports, it adds up quickly. Ramp handles all of this automatically. Ramp is a corporate card expense management platform that over 40,000 companies like Shopify, CBRE, and Stripe are using to streamline their financial operations. But here's what makes their corporate card different. Every transaction gets automatically categorized and matched to receipts. No more wondering what that $47 charge was 3 weeks later. You can set spending controls, get real-time alerts, and even block certain merchant categories. That sounds pretty cool. It's like having a finance team member embedded in every purchase. The platform integrates with your accounting system and ERP, so everything flows through without manual data entry. Whether you're issuing cards to a few employees or managing spend across departments, Ramp gives you visibility and control without the paperwork. Stop chasing receipts. Check out ramp.com/thepeel, get $250, and see what a corporate card can actually do for you. Time is money. Save both with Ramp. Okay, so I just found out why so many VCs are losing deals to funds that shouldn't even know that a company exists. Turns out Harmonic has become venture's worst kept secret. It's the startup discovery engine powering 8VC, DST, First Round Insight, Redpoint, and many other great firms I can't mention publicly. Everyone's on it. And the best part is their AI agent Scout. Scout doesn't just find companies, it actually thinks about them. So while you're drowning in pitch books searching for API-first developer tools, just type in something like company similar to Vercel, but focused on AI workloads, and Scout evaluates thousands of companies, ranks them by fit, and then Harmonic flags which ones your network can actually intro you to. So while some of you are out here refreshing Twitter and my podcast feeds for deal flow, begging for intros, everyone else has Scout and Harmonic do all the work. This is the new table stakes. If you're not on Harmonic, you're playing a different game than everyone else. Visit harmonic.ai/Turner to learn more. That's harmonic.ai/Turner to learn more. Dan, how's it going? Welcome to the show.
Thank you very much for having me. It's great to be here.
Yeah, I think this will be fun. I've been following you on Twitter for, I don't know, a couple years. I don't know when you've really kind of ramped up on there, but you share a lot of really interesting stuff. And that's kind of what I wanted to talk to you about. A lot of research around venture. I feel like there's not enough people talking about that kind of stuff. So I'm glad that you're here.
It does feel like I kind of found a niche, like underexplored niche. I really enjoy like shedding light on some great research around VC that has really important implications for investing, but doesn't get the attention it deserves.
Yeah, and is it kind of related to what you do? I know. I just want to ask you super quick. So your title is head of insights. You work at a company called Equidam. Like, what is it exactly?
Yeah, Equidam. Like our mission in a nutshell is to make really like unique, innovative, idiosyncratic companies more legible for investors. To better explore, like that there's kind of this two-sided equation of pricing in venture. One side is like fundamental value. What is the kind of future cash flow going to be of a company, and how does that discount back to today? Like financial math side of valuation. And then there's the like auction house mechanic where you like compete on pricing and bid stuff up. Our perspective is like the first part is poorly understood, partly because it's complicated and like it's a chore to get all the data. Yeah, for sure.
Yeah. I mean, how do you predict the cash flow of something that's not even a business yet? Like, that's kind of hard.
Yeah, exactly. So our perspective is like, if we can make that easier and better understood, then it's good for everybody.
And it seems like you probably just spend a lot of time reading and doing research around all this stuff.
Yeah, I would say so. I mean, like, it's kind of extracurricular for me in the most of the like VC research side I look at it, or I share or I write about is like personal interest. Probably about a quarter of it relates to Equidam. So like I did a lot of work quite recently on understanding the typical required rate of return for VC. So then we build that into our methodology for the VC method.
What is the required rate of return in venture?
It like basically boils down to a pre-seed investor should be looking to hit at least a 200x in value. And then like as you go up through the stages, it obviously goes down in the multiple that you need. But there's a ton of maths behind it, looking at the dilution you expect to accrue over time, the success rate at each kind of milestone that a company goes through, a few other pieces in there that like basically tell you what you need to achieve for an investment to be good.
Interesting. I swear I'm not lying to you. That is sort of my general kind of window I kind of think about, where you probably want a 100x return on capital. Like you want 100x just generally return, like increase in share price or increase in like value or position. But you usually get diluted. Like I usually just say you probably get diluted like 50%. Might be more, might be less. I mean, it depends. And so I just say usually you probably need 200x return in valuation in order to make the math work.
There we go.
Yeah. I mean, it's super lazy math, but I feel like people kind of overcomplicate a lot of this stuff too. Like it is pretty simple. It's like you buy a piece of a company that's not worth very much, that could be worth a lot in the future. That's all it is. And getting that right once is very difficult. The more times you do it in like a little basket of investments, the more likely one of them will happen. And I think there's kind of a trade-off of like, do you need to do it 1,000 times? Do you need to do it 2 times? I think the data says like 40 is kind of somewhat optimal, like highest chances of optimizing returns. Is that right? Or I guess it depends on the stage.
It depends. Yeah. I mean, there's obviously like very much diminishing returns after a certain point. Like I think you can go up to about 80 and it's still reasonable. But yeah, certainly like 40 to 80 is a good space to aim for.
Yeah, I think public markets, they generally say past 20 to 25, you start to get diminishing returns to diversification, which is kind of interesting. So I guess it's like the level of liquidity that you have, that could be it, or like maybe it's like maturity stage of the businesses.
Yeah, predictability is a big factor.
Yeah. How do you think about just venture kind of today? Like, what are your general thoughts on the market when you're thinking about it from like everything that's going on and what you kind of know should be happening, shouldn't be happening? I don't know. What when I ask you about this, like what's your response?
Like the hot take is like, what is venture? Really? So much of the activity that we're all looking at the moment is like technically venture because it's like venture allocation. It's in the same bucket for LPs as venture capital, but is it really? I would say maybe not. If you'd asked kind of like a lay person what venture capital was 15 years ago, their imagination would have been like a small firm managing a ton of money, going out looking for people building crazy stuff in their garage and making outsized returns off that kind of investing. Whereas over the last 15 years, it's increasingly become like financial engineering and investing with like through a spreadsheet, kind of engineering markups with lazy processes and more oriented towards the fee collection part rather than the carry part. All these incentive problems that have been pretty well hammered. But nevertheless, it seems to be the case.
Yeah, and it's interesting when you just say you pull up like PitchBook or any of these like data, or there's like a report on the amount of capital that's invested in venture capital as an asset class over time, and we always see kind of like the big takeaways and the top 5 numbers, and it's like the past probably year it's been like OpenAI, Anthropic, SpaceX, maybe Ramp. Maybe I'm biased because they sponsor the podcast, and there's probably like one other one that's raised hundreds of millions, billions of dollars. There's maybe like a deep tech one that I've never heard of that's raised $1 billion, and those are probably like pretty mature businesses. Like all those companies, like OpenAI is like probably one of the top 5 most used consumer products in the developed world, right? Like it's not really a startup anymore. You can argue margins, how profitable is it really? They do generate a lot of revenue. People pay for it, but it's not a startup anymore. There's not uncertainty on will people use the product? So it's almost like, is it a different type of financing? Is it fair to classify the OpenAI $40 billion round that they're putting together, whatever the number is? They're building data centers, whatever, with the amount versus a pre-seed, they're raising $1 million to whatever, something completely different, not AI. It's like biotech or something. We're inventing cancer drugs. They're just kind of different things, I feel like.
You've also got to think about the definition of a startup is surprisingly not simple, I think. Is OpenAI a startup? For all the reasons you mentioned, probably not. But also, they're thinking about branching into wearables. They have a ton of stuff on their product roadmap that we can't even imagine right now. Is the chat interface going to remain the primary way that we interact with their products? Maybe not. So there's still a ton of risk left in the company, or a ton of uncertainty left in the company, which maybe means it is a startup. It's just an unprecedentedly large startup.
Yeah, well, I think one of the recent episodes that came out right before this was with my friend Dan Fader at the University of Michigan, and he did kind of make the point. I think he kind of buckets into 2 categories where it's capital for ventures and adventure capital. It's basically adventure capital is we're going on an adventure. We're trying to figure this thing out. And then capital for ventures is you have a venture, you have a business. We're going to put some money in because we know it kind of works, and you kind of scale up this thing that works. So, yeah, I mean, it's an interesting point of there's probably some companies that are only raising a couple $1 million where it's just a capital for their venture. There's not a lot of risk. It's we made a SaaS tool that works. It's this AI agent thing. We have good margins. Everything looks good. We kind of want to put the pedal down and go really fast. And we kind of know this works versus, it's OpenAI. We don't know if people are going to use our wearable products. Who knows? They might not.
But unfortunately, the fundraising for that SaaS company, I think, is unnecessarily difficult today because they don't fall into the camp of explosively fast growing AI companies for I think, which are absorbing obviously a huge amount of investor attention. And there was kind of more experimentation with different models of venture. A few firms that tried to do more moderate risk investing, looking at maybe smaller companies with more stable growth, with better margins, but not traditional venture levels of risk. But most of that seemed to die out in 2022. That reset took away whatever little innovation there's been in the venture market in the last couple of decades. It really started to emerge in 2020, 2021, but sadly was kind of washed out the next year.
I've definitely seen people, I don't know who is actually doing it. I bet there's people that are doing it, but really it's a dividends. You're actually paying out dividends because the companies have cash flows. I think the debate there is always why are you giving people an 8% return with a dividend or whatever the number is? They should be reinvesting in the business to grow faster. And I think it's kind of the trade-off with a startup, which I think to keep it simple, you probably shouldn't do that. Like it is easier, I think, and more simple. It's easier to bucket it in. If you're an institutional investor, you're like, oh, Dan, you have this fund. You just do early stage, 50 companies. They're all going to fail except for one. This is a good strategy. We get this. But if you're like, oh, but some of them, we might be giving you cash flow back. And like, there's, some of them are like tokens because it's crypto, and some of them are equity, but half of them are safes. And like, even some of the safes are going to start paying dividends. So like, we don't actually have the corporate documents formed, and like, there's income coming through, and there's all these K1s we have to solve for. Like, it's kind of complicated. I think it almost becomes not worth it to dig in for the average LP.
For sure. Yeah, I think it's a specific product, maybe for a specific kind of LP that needs returns on a certain horizon. I think an overlooked fact in a lot of VC commentary is like the different categories of LP and the different preferences they have. It does shape what they look for a lot.
Yeah, because the thing that I think a lot of people kind of forget about is QSBS, which is basically, I mean, I think they actually made changes to this rule recently, but you can get a certain percentage, like a certain number. I think it's like 10 million in gains, or maybe 50 million in your gains in things that meet a certain requirement, tax-free. So if you're investing in smaller-ish funds where let's say you're 10% of the fund, you invest $5 million, you get 50 million back or 55 million back. That entire 50 million of gains is all tax-free. There's like I'll throw a link in the show notes, QSBS. I forget how they changed it, but I think you need to like hold it for 5 years. It needs to be a certain type of company. Like it can't be real estate related or something like that. And it can't be a few other things. Like maybe can't be biotech or must be healthcare related or something like that. There's different classifications for it. But that can change how you make decisions too.
For sure. Definitely. I think there's also like a second, less well understood QSBS provision that allows you to write down some of your losses, but it's like for some reason not generally applied in venture. But
yeah, we don't write things down in venture. It's not good. It doesn't make us look good. I actually have a friend who has a pretty interesting strategy where he donates to charity his overvalued startup stock. So like you get the benefit of the tax write-off of saying, hey, I'm donating this equity, like I'm donating this valuable thing to a charity. And then it is not worth that much, obviously, because there's an overvalued startup stock. And it's like an interesting way to do tax, optimization. I think that's kind of like one of those, secrets of the wealthy, quote unquote, type strategies you might see like a clickbait YouTube video for. But it's an interesting way. I mean, that's part of it too, is like, how do you optimize on taxes? Not a lot of people talk about, which is less fun. It's way more fun to just say, we're backing the next Elon Musk and this is the next SpaceX and get in or else you're going to miss out. Way easier to say. Do you think, are we in an AI bubble right now?
That is something I've spent a lot of time thinking about. Like if you'd asked me as little as a month ago, I would have said absolutely and obviously, but actually maybe not.
This is a classic top of bubble type thing to say.
I know. Well, yeah, it depends, right? Because I think when you think about a bubble, you're thinking about investing in a speculative asset that is massively detached from like the intrinsic value. The problem with that definition as it relates to AI and VC today is I don't think VCs are generally acting like investors. I think they're acting like traders. And if they can get out of their positions before the thing crashes, then it's a good trade. Like it's not, and I think like they kind of, in a cynical way, recognize that. They all see there's like a crash going to happen, but they are just hoping they can get out before then. And if they do, it's a good trade. If they don't, it's a bad trade. But it's not necessarily a bubble. I think like a bubble, if we get to a point where like OpenAI has gone public, Anthropic's gone public, maybe Cognition, a couple of others.
I think Mistral was supposed to or something, but I think they recently did a round with like ASML, I think.
Mm-hmm. But like once they're in public markets, then I think we could see a bubble. because of obviously more liquid market, it's more responsive to sentiment. It'll climb much faster and crash much harder. But for the time being in venture, I think it's like you kind of have to recognize it as a trade on the wave of AI. So like if you invested in an OpenAI in 2017, that was an investment. If you started investing in AI companies in 2022 as a strategy, probably that's better characterized as like a trade on the momentum of AI. And you're hoping those companies will ride that trend, generate good markups, maybe get a good exit. But like primarily you're betting on the category.
Yeah. You sure 2022? What about, I feel like that's a little early.
Yeah, that could be a bit early. Let's say 2023.
23, yeah. I mean, 23 was, it was like the entire market was just scorched. And that was like the only thing that was moving. I think like there's just so many incentives where you have to, I talked about with this, Dan, too, in that other episode, talking about relevance, where you have to like remain relevant as a VC, as an investor. So it's something I kind of struggled with a little bit, especially during like kind of the Web3 mania. When I did my very first fund for Banana Capital, I invested in a little bit more consumer stuff than I do now. So I'd kind of been going into 2019, 2020 thinking that, liked e-commerce just generally as a trend. And it got stretched pretty far during COVID as I like deployed the fund and as I first invested the fund. I think I messed up on not like just rationalizing that. Like I think it's so hard when you're in those moments to really realize what's kind of sustained. I personally still don't really like going to stores. Like I personally do a lot of things online. I'd rather order ahead and pick something up. But I had a lot of my LPs that are like, Turner, why are you not a Web3 investor now? Like we thought you'd be doing Web3. Why aren't you in Web3? And it's pretty easy today to look back and
I bet they're happy about that now.
yeah, I mean, I think that fund will do okay. Like my 2021 fund that was like over allocated to consumer. I don't know how these things are going to benchmark. Like I'm going to make money. I'll give people their money back. I'll get a little bit of carry from it. But
at least on like a relative basis to the market, I like you probably do very well because the market as a whole, I think, is going to suffer that for that year.
Yeah, but that's another thing I think you need to remember in venture is like there's relative and absolute. So like in 2021, I was on a relative basis. I was like, oh, I'm not investing in Web3. I'm not investing in these pre-launch, pre-product, like pre-line of code things at 100 million post money. I'm doing it at 50. That's like half off. Like that seems like so reasonable. But then when you back out and look at it over like a full economic cycle or like a 20, 30 year period, that's still a pretty high entry point. Like that's still, you might be 50% lower than everyone else, but you're still 2, 3, 4x probably higher than you should be. So yeah, they're all 10x higher than they should be, but you still fucked up at the end of the day. So, and like the point of this is make money. Like I think the point of venture, you have to basically outperform every asset class. Like that is a job. That is like the role of venture. People aren't in venture to like, give me like some buffer or like when bonds are down, like I need my venture portfolio to like do X thing. Like it's uncorrelated, but it's uncorrelated because it's like just find people starting things that will be worth a ton in 10 to 20 years. And
if your definition of venture is like what we think of as traditionally venture.
Capital. Yeah, exactly. Traditional early stage. Yeah. It is a good point of like, I think we just need to think of we need a new name for kind of later stage venture, like late stage venture. I don't know. Like I like capital for ventures is a good one.
Capital for ventures is good. Leslie Feinzig calls it consensus capital. Kyle Harrison calls them like the agglomerators. I call them the venture banks. It does need to be recognized as a different strategy, with maybe like still within the same bucket, but definitely a different strategy because it changes so much about like the expectations.
I think it's hard too because if you're any of these data providers, like you don't always know what the nature of a round, like I mean, this is a classic thing in 2021. Someone would say, we raised $100 million for our fintech company, and it was $5 million in equity and $95 million in debt. And so my general, when I see a number like, oh, you raised X amount of money, if it was around a seed, Series A, I usually assume seed, you saw about 20% of the company. If it's a Series A, I assumed you probably sold 25. You maybe got diluted about 30 because there's some like options and stuff like that went in there. So if I see that number, oh, we raised $100 million and it was a Series A, I'd be like, oh, wow, $400 million post money. What's an appropriate valuation? Like they must be pretty far along. But it's like, no, they only raised 5 million. They have one customer. Or actually, I guess that's the other side is like if you got a debt vehicle that you raised, you probably have a pretty robust business too. Hopefully, you probably passed certain levels of sophistication and maturity and able to prove that. So, but yeah, I don't know. It'd be hard, I guess, to really actually figure out how to do that. It's almost like it's just easier to just not worry about it and just call it all venture.
It's an interesting point though about like what that does to the perceptions of valuation, because you have like people making calculations, like you said, where
because it's all comps. Like I just say, this is Dan did this. I like this is public. This is what he did. I'm better than him, or I'm at least as good. So I want to get the exact same amount. And if it's not, then it's not fair.
And you have like the debt part of that, which complicates it. You also have like obviously the terms, like was it raised with a 2x liquidation preference? Like what other more investor-friendly terms were attached to make that valuation work? You never really know any of those things. Has a very like pro-cyclical effect on pricing.
And then I have some friends who they have like they strategically release and drip certain information. So they will be, they'll say we just crossed 40 million in ARR, but they're actually at 80 or something like that. Like they strategically will put things behind. I don't know if you know that company, bolt.new. They're like the text to website creation. So I kind of figured it out from talking to him, and we talked about it on the podcast. Is he like, yeah, when we announced where we were at, we were actually a little bit ahead of that because he was in a case where they were just exploding, and he was like every day waiting for it to taper off. And he's like, it just never died, and I was just afraid that if I set a number and like the number was no longer there, like. So I was like, okay, let's hedge a little bit. So I think that goes into it too, is like, and then there's on the other side of we're like, oh, we're at, 100 million ARR, but it's like a creative definition of the word ARR. So again, a lot of that stuff is so tricky.
Yeah. It's a huge problem. It's kind of interesting to me as well. The extent to which like a company hoping for an exit for an IPO knows that eventually one day they're going to have to get to like GAAP compliant financials. They're going to be audited. So for how long can you keep that kind of mirage going early on of like the creative bookkeeping? I think it's kind of dangerous. And again, there are like incentives on both sides. Some VCs kind of like it too, because it makes it very easy to generate markups on multiples.
I don't want to miss this question because we talked about it a little bit earlier, but you mentioned that you think basically like all of the returns in venture ultimately come from sort of the first check, like true venture capital, the traditional where like how we sort of defined it earlier is like you're starting a company, extreme amounts of risk and uncertainty. Like what's the importance of that kind of origination round, that like first round, but whatever we want to call it?
It is. Like it's kind of axiomatic a little bit because obviously, like if you don't have a first check, you have no checks. You don't exist.
You need like that risk capital, the inception stage, origination stage.
Yeah, exactly. And investors that focus on that level, the real like genuine first check investors, and I'm not talking about the ones that need to follow someone else into the round and need traction or whatever. They determine like what venture capital is in a way. Like they determine what are the exits going to be in 10 years.
How do they determine that?
If it never enters the funnel.
Got it. Okay. So they're like determining what is allowed to exist. Like what startups are able to have a shot at trying to do something.
Exactly.
So if they're only funding certain categories.
Yeah, the quality of what is in the whole venture fund or venture funding pipeline from origination to all the way to exit at any point is like downstream of those investors. So their ability to like provide good coverage, to be able to explore every corner of the economy, every category, every industry is super important.
Should there be like more people doing that, more creative? What does the data show?
It shows, I mean, like that there's been a very good study done looking at VC in Europe. And it showed essentially looking at programs like big programs by like the EIF, the European Investment Fund, where they put a ton of capital into VC. You get the same like uplift in productivity from that investment if you just move the current allocation earlier than if you double the amount of capital. So like expanding the like early stage origination area of the market has just as good effect as like doubling the total pool of capital.
So if you're investing 100 million in startups, tech, innovation, whatever Europe's doing, if they instead, and then they wanted to double their impact, probably like the most consensus thing, well, let's just give them twice as much money. They'll have twice as much of an impact. But it actually have double the impact if they just went half as earlier, or like how earlier, do you know how early you have to go?
It wasn't too specific, but I think like essentially it's ensuring there's enough money at the like pre-seed, seed, series A maybe kind of stages. Make sure those companies have a path to like really prove the business model and become success stories.
So why do you think more focus is kind of around this origination stage? And it's interesting because I feel like a lot of people say we're pre-seed investors, or like we back founders from the earliest stages, or whatever they say.
Yeah, but like the biggest question there is not necessarily who classifies themselves as an origination investor or a first check investor. It is what is the strategy that they apply to origination? Like, where are they looking? How do they source companies? Is it through a network of peer analysts or firms or other GPs that they know, in which case it's already kind of coming through a filter? Or are they genuinely doing like essentially like the equivalent to a startup of go-to-market? Are they doing that? Like, do they have a unique defined strategy to go out and find their own deals? There's a few examples of firms that I think do that famously well. My favorite is always 1517 Fund, because they invest like $2,000 in a college kid with a dream who has nothing. But that kid is like, okay, now I have the money to test this idea a little bit. And if I then start a company, guess who I'm going to call? It's going to be Danielle.
The one who gave me the $2,000, and it's a grant, right? Like it's free.
Yeah, exactly. It's literally just like at that point, it's a Venmo.
Yeah. The corporate Venmo account of 1517.
Yeah.
I wonder if that's actually there. I should ask. And I think, so what do you think about maybe like a YC? Is there an example of a good one?
That's a very good question. I'm kind of torn on that, because I've written at length about like YC and YC's track record and their performance. I've always kind of defended against accusations that like YC companies are overpriced, because if you look at the historical success rate, they should be priced higher. They have a higher success rate, higher rate of exits. The question is like, that involves looking at data from companies that are obviously at least 10 years old. So has YC changed in the last decade? I think is an interesting one to consider. If you look at the breakdown of the cohorts 10 years ago, 15 years ago, how much like thematic consistency was there? How many companies were like in a very specific category of technology? Essentially, like how diversified was it across different ideas compared to today, where like, you know, you see people saying like there's 20 different windsurfs for X in YC currently.
I think the interesting thing that YC has too is they kind of have this like built-in price making mechanism. Like if you think of in an auction market, there's price makers and price takers. And YC basically gets, as valuations keep going up, they have been able to keep this lower price that they come in at. I guess to your point, the way the market's changed, they've changed where they now do put a check in at that higher price, that kind of uncapped safe that they go alongside the first check. So I bet there's like sort of like a weird step. There might be like a step function change, and like maybe some of the YC funds was like an 8x fund, one was a 12x, whatever. But like I bet you get like a slight bump down by like a full multiple. Like that might be a 7x or an 11x, but it's probably like a bigger pool of capital that you get to work with. So it's probably okay. Like if I'm an LP, it's like, okay, instead of my LP exposure to YC being like $5 million, I got to put in 20. And I'd actually rather get a 7x on 20 million than an 8x on 5. I don't know. I have no idea if those are YC's numbers. Those are pretty good numbers. I bet they're actually higher than that, honestly, is my guess. But to your point, I think an interesting kind of topic that brings up though is we're like looking at historical data. Like some of these studies are in completely different market structures, completely different market regimes. So there's like one end of the spectrum you could say, you know, things are different. Like you can't rely on this data. Like all the maybe non-data supported things that the venture industry does is actually correct because all the data is wrong. The other end of the spectrum, like that is just a classic thing that you say when everything is about to be over. Like history doesn't matter. Like this data, like we don't follow. Like it's like the whole "do you want to make spreadsheets or do you want to make money" argument.
Yeah, I share a lot of old papers. I get like a few different forms of pushback to this. Like I shared one a couple of weeks ago, and a GP replied to me, and he was like, "This is from 2017. Like, there's no way this is relevant today." Like venture capital, in the like traditional sense that we've been talking about, has not really changed that much. It's not changed much at all, for 30 years, I would say. Like there's the bigger end of the market, which has been added, but like the traditional part, like the risk factors, the decision-making process, the portfolio strategies, like all of that is the same.
So it's sort of like venture capital started as like this pretty small pool, very beginning stages of the market. And it's sort of like it stayed there, but it's also expanded to become further and further along. And all that expansion is like 10x, 100x bigger than what the first kind of initial inklings of it was. It's still there, but this whole expansion just takes up most of what we think of it today. So it's just like it's still the same, but it's evolved, I guess. There's new extensions of it.
And I think it's evolved in a very like expected way, in that the larger it's got, returns have like commensurately fallen. And you could almost think of it as like a dilution of the strategy. Like it's literally just like more capital, which allows for the scale of returns to be increased, but not the efficiency of returns to be increased.
What does that mean? Can you explain that?
It's like if you're a big sovereign wealth fund and you have to write checks of like a minimum 100 million into funds that you're investing in, you can put that into like a venture bank, A16Z or General Catalyst type firm, and they can put that to work, and maybe you'll get like a 2 to 3x on that money. You can't really invest it in the early stage of the market because it just doesn't fit. You can't squeeze a check that large into a smaller manager.
You'd have to do like 10 or 20 different funds to get that $100 million deployed.
Exactly. But if you could break it down like that, maybe you could get a higher total multiple, but it's more work, more risk potentially.
That's sort of the pitch for a fund of funds then, where it's like, hey, give us $100 million. If we have a $500 million fund in the top, whatever, 20, 30, 40, 50 best managers and all their breakouts. It's kind of like hiring a consultant to manage your venture portfolio for you, but they just kind of do it. It's one line item on your portfolio and one headache you have to manage, one update call, one relationship versus 30 or 40 or 50, which that's a lot of time. You need a whole staff to do that.
I think if there's one like startup idea that I could be tempted by in future, it would be trying to design an algorithmic fund of funds. Like, so it could be very low fee, very efficient, but basically index emerging managers to try and manage a lot of like the uncertainty involved in that. But to build a process around like managing the biases involved in selection, all the uncertainty involved in selecting managers with no track record, it would just make fun, like for that section of the market, which is like the origination layer too, which I obviously care quite a lot about. It would make fundraising so much easier if they had access to that kind of capital.
I don't know if it's true, but I've kind of had this like maybe hypothesis. Is there some sort of survivorship bias in, I think it's like fairly well known that people say emerging managers outperform, fund ones outperform, and you should just, if you want true venture, if you want the best venture returns, invested in fund ones or whatever, emerging managers. But I've always been curious, is there like a survivorship bias of like, let's say you and me both start funds, you crush it, you're doing really well, I fucking suck, and I just like drop off, and like my data, does my data like leave? And so all that they see is you crushed it, I sucked. We offset each other to like equal, or maybe we're worse, but I dropped off. So only your data shows up. Have you seen anything related to this before?
That's interesting. Nothing specifically to that. I mean, I will say some of the perception about how emerging managers perform or outperform is based on like a lot of charts that the PitchBook have released, where they show like who have been the top 10 funds in each vintage by size.
Is this PitchBook or Cambridge maybe?
Could be Cambridge. Yeah, you might be right about that.
And they're biased. I mean, they're trying to sell institutions on new funds.
That's true. But they like consistently have shown like small, like sub 50 million funds, for example, like dominating the top 10 each year. But actually, if you look at the underlying fund data, those small funds are massively overrepresented in the data set. So like it's obvious that they're going to take more of those top 10 positions. It doesn't necessarily mean that they're a better bet, because there are a lot more of those funds that also obviously don't do well.
That's true. I mean, it's extremely difficult to raise capital for a fund, and especially when you have not done it before, you're first getting it started. So there's probably not very many large early funds. And also, if you're good, like you just keep getting bigger. So it's kind of hard to be like it's really hard to just stay small.
Which is one of the problems with the origination part, is if small firms focus on origination, but success naturally inclines them to grow, then they slowly move out of being able to invest in that like such an early stage, and they start to invest larger checks later rounds. So that whatever talent they had at origination is kind of washed out, which is a shame, because there's already very high churn in the industry. There's already like relatively weak persistence. So, it's a difficult part to make talent stick.
Can you explain for somebody who may not understand this of like, why do you want to have a bigger fund? Like, why do small funds that do well ultimately end up getting bigger?
I think there's probably two main forces. The first one is the obvious one, which is the financial incentive, because you have, as a part of your compensation as a GP, you have your management fees and you have your carry. And the carry is you could consider it like a performance bonus. If your investments do really well, past a certain hurdle, you get to share in that profit, which is, if you're a great investor, it's incredible and can be a huge part of your compensation.
You need to liquidate the asset though. Like it takes a while. In venture, it's probably like, I don't know, 8 to 10 years until you get any of it. Probably longer, honestly.
Because you have to first return all the capital to LPs. Yeah, it's a headache. It's difficult. Whereas much easier is the other part, which is the management fees, which are guaranteed. You get them pretty much no matter what. And that's like 2% a year, or like probably these days more like 2.5, I think, a lot of the time. Probably over 10 years, but then there's extension periods and caveats around that as well. But if you consider it like 2%, 10 years, it's 20% of the fund.
Yeah. You raise $100 million, you get $20 million guaranteed. Like, you think of that like an ACV as a SaaS business. That's an incredible business. Like, that's like, you raise $1 billion, you get 200 million in revenue. It's like guaranteed over 10 years. Like, that's an incredible business. And you just keep doing it again. and you raise another fund. So then you raise one fund that's $1 billion, you get your $200 million in revenue. You raise a $2 billion fund because you did well. Now you got $400 million stacked on top of that $200 million. And just like, let's say you started your first fund was a $10 million fund and you got a 10x return on that fund. You took that 10 million and you turned it into 100 million. So you got 90 million in profits and you got 20% carry. You got 20% of that. So you get like 18 million bucks in profit. You probably get it 10 years. So 18 million in profit, that is like, if you go back to that $1 billion fund that you raised, you're getting 20 million a year. So it's like, why am I fucking around waiting for all my carry? Like just raise a big fund. It does make sense. But I think the issue then though, you might trade off. And this is something I've thought a lot about is like, you have to like build that infrastructure, pay for it, which is usually a team, a lot of people. You have to manage a lot of things. You spend a lot of time on that like operational, institutional design. So yeah, you get a lot of management fees maybe, but depending on the circumstances, it's not quite as lucrative as you might think. But you do get leverage depending on who you bring in. You may be investing in things that are defensible network builders or brand builders or something like that. So it gives you more capital and power to kind of work with. So
I think it's kind of useful to look at the extremes. Like I think consider like a small like 50 million fund, just a couple of GPs and very little else in the firm. They're spending their management fees on like living, travel expenses, events, whatever powers their origination strategy that they want to do there. But it's like basically covering the cost of operations, and then they cross their fingers that the carry's great. Whereas the far other end of the spectrum, like an A16Z, the range of services that they provide for startups, like now they have their own compute that they provide to AI companies that they invest in.
Oh, so that is a thing. I thought that was a meme.
No, that's a thing.
A joke. So it's real. Okay.
That's a thing. And they have other financial products that they offer. They have the whole platform team.
Yeah, they have anything you might want. Any department that your company will have, whether it's recruiting, marketing, capital raising, go-to-market, growth, brand, engineering, like they have consultants that can help you come in. It's everything. It's like any role you might hire for, they have it. They can help you with it. It's an interesting value prop to some companies. And there's also just the brand halo of like A16Z. All your friends know A16Z. They've all heard of them. They've seen the podcasts. Your parents probably used the Mosaic browser back in the 90s. Why would you not take Mark Andreessen's money versus some random dude with a podcast that no one's heard of? It's an interesting value prop.
It is. That's a whole fascinating rabbit hole itself. Like, what is the cost of taking money from these big firms?
What do you think it is?
There's a great thread by a VC called Rob Go, and he reflects on this as like re-risking, because essentially like their value prop, part of it at least, is that they will be less price sensitive when they invest. So they will give you much more money on much more friendly terms, potentially.
This is a larger agglomerator of capital type fund.
Correct. Yeah. Yeah. Like an A16Z, exactly.
Not Rob Go at NextView? Is that NextView?
Yeah, that's right. That's right.
Okay.
So the downside of that is the growth that you kind of obligated to deliver as a part of getting that huge check is way higher. Like the stakes of failure are higher. The risk you're taking on as a company by accepting that much money is much greater. The fragility of your like future vision, like how you can adapt if things don't go to plan, like that's much more difficult. So essentially what should happen through a startup's life is as they develop, the risk slowly goes down. You end up raising these huge rounds and your risk shoots back up to the top again. And then you need to work it down again. Like it's, for some companies in some categories, it's the right move.
Great. Yeah.
Yeah. But for many, it's probably not.
How do you decide that? Is it like how much capital do you need? Is it like a competition? Is it like a certain product type, like capital efficiency or something? Do you know if there's a way to gauge that?
To some extent, it's a bit of a competitive force, I think. Like if all of your peers are in the same category, are raising similar amounts of money, to some extent, like maybe you kind of feel like you have to as well to compete with them. And that ends up with like an ugly situation where everyone's spending huge amounts of money, like bidding their own margins into the ground against each other.
Yeah, some kind of a paradox. I'm sure there's like a scientific word for this, but like some sort of like loser's prisoner's dilemma type paradox or something.
Yeah, it's basically venture predation. There's a good paper on that.
I'm gonna throw Rob's thread, and I'll throw this one in the description too.
Yeah, that one's looking at like, I think it uses specifically the example of like Uber versus Lyft. So they both absorbed a ton of VC money, and a lot of that money was put to work basically at trying to suffocate the other company. Like, who can undercut the other company's pricing enough that you steal all their business? And can you survive long enough doing that before you die yourself?
Interesting. And it's crazy how I think Uber is like this fascinating example where it's like super profitable now or something, right? Like they just basically like 3x prices over the past couple of years. And it's like all free cash flow. Like I haven't looked, I don't know the number, but it's like pretty much they just had a ton of pricing power that was kind of hidden and we're all paying it and they're making a ton of money now.
They also nailed their timeline, I think. Like the period of time from inception to exit that they had, luckily, was kind of perfect. They could have exited like maybe a year or two later. I think it was 2018, their IPO, something like that.
Yeah, 18, 19 probably.
But if they'd been intending to exit in like 2023, and then suddenly they would have hit that speed bump when all the capital dried up, that could have been fatal.
And they kind of did hit some speed bumps right before the IPO also, kind of, with the whole management team turnover.
Yep. Yeah, that's another interesting rabbit hole.
And you turned me on to this interesting concept. I think it's called startup catering. I think there's like a research paper on this. Like, what is startup catering for people who don't know? Because I think of food. I think of like, getting lunch for the company, but like, what is startup catering?
It's probably my favorite paper on VC, which is an incredibly nerdy thing to say, but like whatever, I've said it.
Hey, we're in an audience of nerds here. We're all on the edge of our seats.
It's a safe space. It kind of crosses over like the valuation part, which is obviously what I spend a lot of time doing, with the what gets funding question, which I think is really important. So essentially catering, it's a consequence of the fact that investment decisions in venture capital mostly kind of like relative judgments. So you look at, if you're going to invest in a company and you're trying to understand, is it a good investment? And if so, what price should I come in at? You probably look at peer companies, you look at comps. So like if you were investing in a B2B SaaS company in 2021, pricing was super easy for you. There's thousands of them. You probably know a ton. They're at every stage, in every region, in every vertical. So you can find a ton of companies that are very similar to the one you're looking at.
Yeah, and it's from all stages, like from the inception stage all the way to like mature public markets. Like I have a ton of comps, and there's like a history of how these things go.
Mm-hmm. Yeah, so you like, in terms of information friction, to understand the company you're looking at through the lens of all these comps, it's super easy. It makes investing very simple. It also means downstream funding is going to be very easy for that company. When they get to the next round, they'll be able to raise very easily as well, probably at pretty good terms. Like, it's just like life is so much easier if you're in one of those categories. The downside, obviously, is that then it's like a blood red ocean, super competitive, like maybe overvalued if investors are all piling in there. Like, there's real downsides too, from the investor's perspective. But the problem from the founder's perspective is if you're trying to do something that is like really unique and innovative. You know, you're like Valor Atomics or Rainmaker or someone. You go talk to VCs and try and explain to them your company and why they should invest. They have no comps. There's no like relative judgment to make. Like there's no other set of peers they can look at to understand your company. They have to, if they want to invest, and probably they should because those companies are often incredible, they really have to understand like first principles foundational value or fundamental value. And that's much more difficult. So the upside of all of this basically is that founders basically have such a hard time raising money for these really interesting, unique ideas that they tend to cater to VCs' preferences. They tend to cater to where there's less information friction. So they're more likely to go and build a SaaS, which I think we both agree is like pretty sad.
Yeah. I mean, you can solve problems, but the easiest problems to solve are probably the most over catered to, I would think. So then why are the VCs investing in it? Because you just said, I mean, based on the last, I don't know, 53 minutes of our conversation, like I would lead to believe like, yeah, those returns are probably going to be pretty low. Why do people do it then?
Gets into the question of what is the primary motive of VCs today?
What do you think it is?
Depends. I think there's examples of both. I think by far the most capital is moved by investors seeking markups, seeking like proxy metrics that show their fund is doing well so they can raise another fund and get those management fees. I think that moves way more money. But ultimately, I think the most returns over time are generated by true like investments, which is like you invest because you see this company as like a generational outlier and you think the exit is going to be huge. You're focused on the like end game DPI rather than the proxy metrics along the way.
And is there a good way to do that if I'm a VC? Like if I'm listening to this and I'm like trying to change my ways, like I'm like a markup addict. I'm trying to get clean of the markups and, you know, purify myself with DPI. Is there anything like you've kind of seen that maybe you can kind of think of or, you know, cling to get through that?
I think there's something said by Michael Dempsey in your podcast with him, Michael Dempsey from Compound. He talked about, if I remember correctly, it was their 2020 fund. And they intended to deploy it over 4 years, but they ended up taking 5 because like they just didn't find the opportunities that they wanted to invest in. That's such a good attitude. And I think you would find that is relatively rare in VC, whereas most people are just like trying to put capital to work, get it out the door, get the next fund. But they said like, we're only going to invest in companies that pass a certain bar. And if it means we have to wait longer, which means we essentially have less income to our firm, then we'll wait. And I think that's a great attitude. They definitely suffered for it in terms of like versus the income they maybe could have had if they deployed faster. But long term, it's the right choice to make. And like those decisions, I think, are how you build like a generational firm and end up being able to charge 3% management fees if you want to in future.
I think because it's sort of related to this whole raising the mega fund model, big pools of capital. Like from my perspective, I kind of see it as like it kind of works, kind of solves this problem in the market. I don't think it's going away, but you mentioned before that you still think it's actually an experiment. So why is it an experiment still? Like it kind of seems like it works. I don't know, and that's like maybe that's not true, but.
Yeah, it's a good question. I mean, I agree with you that I think it definitely has a place in the market. And I went personally from like 2-3 years ago, I was very critical about it because I thought like, you know, it's just like basically grifting. It's just collecting fees. But actually, if you look objectively at what the big firms have done, it's pull a ton of capital into like tech, which has got to be a good thing ultimately. The question is, how does that strategy work out for their LPs? And I think we kind of have to see to an extent just how that shakes out over time. For example, I think AI is like kind of the backbone of their strategy at the moment, in that, like, it's where they dominate. They have enough money to back the big, like, foundation language model companies. They have the clout, the media presence, the marketing pull to not just promote the portfolio companies like normal, but to promote the whole category, to build momentum for it, to like push it in Washington even, and certainly to like pull in other investors, like to herd in more capital. So to an extent, are they like manifesting a wave and then trying to ride that wave by indexing a ton of companies that kind of join onto it? Is that going to work? Like, it could be incredible. Like, it could be 6-7x on a huge pool of capital, which would just be like amazing results. It could be a failure ultimately, or it could be something that they can't repeat in future. Like, that's why it's kind of seems like an experiment to me. Like, is it going to persist beyond the current AI wave?
Yeah, that is a question. It's like, because it feels like we've kind of, if you just look at like the history of venture over the past 15 years, it's like we keep finding new, bigger opportunities. Some people might call them new bubbles. Like, we're riding new bubbles. Like, you could look at NVIDIA's stock price. Like, NVIDIA, at the top of crypto, I was like, this is crazy, insanely overpriced. There's no fucking way NVIDIA goes any higher than this. And it's like 20x higher than the top of the crypto bubble, because people are using the NVIDIA chips to like mine crypto. And like with VC, it's like, it was ZERP. It was, low interest rates that were just fueling higher asset prices. We had kind of like the COVID work from home, all the SaaS companies were overvalued. We had kind of like the Web3 stuff. It's like everything is going to be on the blockchain. The economy is like $100 trillion. Like, fintech is like a massive market. It's all going to be on chain. And then with AI, it's like labor. Like, literally the entire economy now is software. So we like figured out, even though like the Web3 thing popped and is gone, it's like we somehow figured out how to find an even bigger thing that venture could eat up. And it's like, what else is there? It's like, we're interplanetary now. Now the number of Earths and the number of economies is 10x bigger, and they're all software. So like, we're going to be colonizing Mars and the moon or something. Or like, do animals start using software? So like, your dog needs a CRM or whatever. Like, I don't know. Obviously, I think one way is like biology or something, like new things that have not been impacted by software yet. Like healthcare is probably an interesting example, where they have not fully utilized the internet or something like that. Or so I don't know. It's like, and then you could say, well, AI, the impacts of it continue to be felt in 20 years, probably. I mean, there's still markets now that are changing from cloud, changing from the internet. So
it's also kind of a question about like LLMs particularly. You could look at it a couple of ways. Like, you could say, using the example of NVIDIA, this doesn't resemble historical bubbles because NVIDIA's revenue has actually gone up so much. Whereas in the past, like, look at Broadcom and the dot-com boom, the separation of the two was much greater. But then there's other signals which do feel very bubbly, like the narrative around what an LLM can do has gone from, in 2023, it was like, we're on the verge of AGI, it's coming, everyone's going to be out of a job. And now it's like Sam Altman saying like, the biggest risk is that maybe we use too many M dashes in our writing. Like, it's calmed down so much. And why? Is the steam gone out of it that much? Like, how much of the capital that's gone into it was predicated on AGI? And is that now not happening?
Yeah, I think it's interesting from like a technological perspective of the cost is coming down, and also like the effectiveness is going up. So when you just say like the internet, I don't know what you used to pay to access the internet, like AOL dial-up, it was maybe like $40 a month, $60 a month or whatever. It kind of sucked, but it was good at the time. It's gotten better, but it's not like we pay less. Like, I was looking, I need to actually go and call Comcast. I paid $230 for my Comcast internet last month for my office, which is way higher than when I initially signed up for. Total different tangent. I'm like, fuck, well, I hate how they always increase the price on you. Like, oh, it's $80 for, an intro deal you didn't know about, and they increase the price. But like, they keep increasing the prices. Or on the other hand, you think of like something like the cloud or whatever. It's like you connect to the cloud, like the internet is on, and like, you didn't get like better cloud. Like maybe the price came down. They add new services where you keep paying higher prices, but like you don't get like better cloud. Like it's like, oh, you're like it's like a better optimized cloud. Like maybe marginally, but I think the interesting thing with AI is like over the past couple of years, it's gotten way better, and the cost to service it has come down magnitudes every, I don't know, 9 months or what, I don't know, every couple months. So it's like one of those things that's getting way better, and also the cost is coming way down. I think you can argue that if you want to keep using the bleeding edge models, the pricing is more expensive, but they're still getting way better. And there are cases where you don't have to use the newest model. So it's kind of one of those technologies where it's getting better and also cheaper, which I don't know if it's happened to that extent ever. I mean, maybe if you go back to like the Industrial Revolution or something like that with like, and that's, I think some people made that argument of like, if you think that LLMs are automating like manual software labor, like computer labor, the Industrial Revolution was automating physical labor, and it was making it cheaper and faster. So that had a pretty profound impact on the world. And so I think that's maybe like an interesting parallel to think about it with AI. I don't know. It's probably not totally correct, but that's one framing I would use.
There's like the kind of incremental improvements as like costs come down and it becomes more accessible and more useful, which I think is definitely true. There's also the like productivity shocks. So like when AI passes a certain threshold to really do something very well for the first time. So I think like the recent MIT paper that looked at adoption in the enterprise was kind of like showed that the pilots generally weren't working out. Like 5% of pilots were successful. And I think that's essentially a consequence of it's not quite reliable enough yet. Hallucinations are still a problem. On the other hand, if you look at Google's recent image model, Nano Banana, fitting for this podcast, it's like, it's so good and so reliable that if you're like a fashion company, you can actually use it to do like AI photo shoots. If you're like a little independent fashion company, you take a picture of the outfit that you've made, you describe a setting and a model, and it gives you a picture that is like so close to real, it's actually usable. And that's a fairly small but meaningful productivity shock, like a real jump in value that it creates. The more of those accumulate, like obviously the more important AI becomes. Some of them are going to be huge, probably.
Yeah, that's a good point. Thinking about how do you quantify that productivity?
Yeah, I guess it's cost replaced, essentially.
Yeah. One other thing when talking about sort of the mega funds and, the way that they fit, it's not like an LP who's putting capital in these things is saying, I'm going to take my origination dollars, stick them in this $5 billion vehicle. It's usually like you're probably taking some public market exposure and saying, I actually think I'm getting higher returns. So I think a common kind of dunk on these funds is like, oh, you're only going to get a 3x, you're only going to get a 4x. That could actually be higher return. Like could actually be shifting that shift into that 3 or 4x might actually be higher returns than they were getting in what they shifted it from. Like shifting that allocation might actually improve their overall expected returns, because you could say that, let's just say like A16Z, for example, we're going to invest in automation and software and the internet and AI in factories and physical things. And that might actually be a better investment than like an industrial buyout private equity firm or something. I don't know if that's true, but like you could probably make that argument. I'm sure there's like a ton of data to support that of like, you might get a 2x on that PE bio fund, but you get a 3x on the mega fund software industrial buyout thing. I don't know. It's probably like a bad argument, but I'm sure like that is like the way. I'm sure if there's like more data, you could support that. Like, if I knew what I was actually talking about, I'm sure. Yeah.
Not only you're right about that, but I think you kind of make a deeper point, which is that if for all that those dollars are currently allocated in the VC bucket for these LPs, if it's not actually competing with actual like capital should go to VCs traditionally, and actually it's probably displacing PE money, maybe that's because this strategy is really PE and it should be grouped in with PE. It's kind of a not something that anyone at a big fund would want to hear, that they're like basically private equity, but really, maybe they are.
Yeah. Well, and it's interesting. One of the prior guests of the show, actually two guests, it's I think it might actually be my only episode with two guests. It was the founders of a company called Solugen. Have you ever come across that one?
I don't think so.
They're basically just making chemicals in a different way. They're making chemicals. They're all the same compounds that go into like petroleum waste and petroleum type products. They're creating it from plants essentially. And the chemicals industry, I think it's like 4 trillion of just like headline kind of GDP economic activity in the world that is like chemicals. So you use chemicals on clothing, in healthcare products, in your computer, in like cars, like everything is like coated with chemicals in some way. And the entire industry is very old, and it's very asset heavy, high barriers to entry. Basically everything, the whole industry is revolving around getting like extremely high volumes through on really low margins. It's been competed away and super outdated. And like, there's no real room to like innovate on anything and like change anything. And it's kind of caused like, you could probably argue we're literally taking oil that's like on my clothing. It's like touching my skin. Like that's not good, right? I'm not dead because of it, but if you think about like pouring gasoline on yourself or like being exposed to nuclear radiation on like the extreme end, that's not good. And it's kind of interesting. Like they're basically like a venture-backed company that's kind of competing in the chemicals industry against these people that have, 10% gross margins and 2% profit margins. That like has bad customer service. Like it's actually interesting. Like when I was talking to them, I didn't believe them. They're like, when you order chemicals, they give you like a 4-week delivery window, right? Like imagine your calendar. Imagine if I sent you a calendar invite for this and it's like a 4-week window of like, hey, show up at some time in these 4 weeks and record this podcast with me. You're going to be like, how the fuck do I get anything done? Like that's so inefficient. But like, that's kind of how that industry works, where you don't know when this thing's going to show up. And so you could say that using that kind of like operational rigor, that kind of like technology to say, we'll deliver this thing at this time and you'll get your product and it'll be made differently. Our margins are way higher. We make things in a way that's way faster and more reliable. The customer service is better. You can actually compete with those industrial buyout type, private equity type model, like that form of capital. So I don't know. I think it's net good. To your point, more forms of capital for entrepreneurs is good, generally speaking.
For sure. There's a ton of big industries with like high idiot index scores still that like are ripe for disruption by that kind of capital.
Yeah. So to your point about like bringing capital forward, it's like that is like a very like late stage capitalism type of capital, like late stage economic activity that you're like shifting the capital into an earlier section of the stack. It's not origination necessarily, but it's still earlier than what it was before. So you're in theory creating more economic profit of some kind, which I hope is good for the world. Like generally speaking, I think that's generally a good thing. So you commented one time about like A16Z is kind of like a common punching bag of like the mega fund model. You actually said their very first fund had like a smart, good strategy. What was the strategy in that first fund? I'm like kind of familiar with it, but I think people would probably be kind of interested because it's probably different than what you'd think.
Yeah, it's interesting. This is kind of the moment when I came across this, when I started to realize like maybe I'm judging them too harshly, because I had this sole perception of them as like the mega fund, that archetype. But actually, if you go back to the fund one, they were like a traditional and very well architected VC firm. Like they were targeting like a level of diversification in that fund that was uncommon, is still uncommon, but I think is sensible. And they had like a follow-on strategy for subsequent rounds that was like more sophisticated than many VCs would consider today. So like on the whole, it was like, oh, these guys actually really do understand VC. So whatever they're doing today is like an evolution.
So what was it? Like, what was the strategy?
If I remember correctly, I think they were targeting something like 60 initial investments in their first fund, whereas the typical today is probably like 20, 25.
Maybe 30. I guess it depends on the stage you're at, yeah.
Yeah, for sure. Could be as high as 30, definitely.
So they were more diversified on average.
Which means they were able to take a bit more risk. They were able to be a bit more idiosyncratic, like choose companies that are like more outliers, less consensus, which I think is good. This is all good stuff. And then they had the strategy for like investing a little bit in the A and then the B, maybe being able to double down on winners, which is like kind of like has been described. And there's a very good paper by Joe Millam called Process Alpha, and he describes like generating systematic alpha through how you allocate capital. And this is one of the things he talks about a lot. Like how you do reserves is actually quite important. And they had a very good grasp of this in like 2009 or 8, I think, maybe.
What is the general best practice in around reserves? Because I feel like there's a lot of people that say every end of the spectrum. What have you kind of seen that you've picked up on?
I've seen like most recently, I've seen a few GPs make comments along the lines of they don't do reserves because the subsequent round in that company is so overvalued that they wouldn't want to. It's not worth it for them for the risk, which is a crazy thing to say. Because is that increase in value not reflecting an increase in potential, you know?
Yeah. You're saying like my performance numbers are fake and they're not real.
Exactly. Like I'll take the markups, thank you very much, but like I don't want to be involved.
Yeah. I'm not selling any secondary either, which is maybe then also a question is like, what?
For sure. But I think like the biggest thing, and this seems very obvious to say, that in any subsequent round of a portfolio company, you need to be able to separate yourself emotionally completely, look at it objectively. Is this a good investment? If I never met the founders before, if I had no track record with the company, if I'd never posted about them, never written a Substack about them, like, is this a good investment? You have to be able to do that to make good judgments. I'm going to keep doing this to you. I can send you links afterwards. There was a very good paper that came out last year.
Do you remember what it was called? I'm taking notes right now, so we're going to throw them all in the description.
It is called The Sunk Cost Fallacy in Venture Capital Staging. And it basically describes how VCs like grow attached to portfolio companies, and probably they grow more attached to the ones that struggle a bit because they're the ones that need the most help. And they don't want to admit they're wrong in the investment. So ultimately they pile in capital when like they probably shouldn't, and it goes badly. So for all that it seems obvious to say like you should evaluate each investment independently as an objective judgment, it doesn't seem to be what is typically the case.
Interesting. Okay. And one comment I think we had like sort of like a public, it was like I think it was a friendly disagreement, hopefully, on portfolio construction. I think there's been some studies that show, in theory, optimal portfolio construction in venture is way more diversified probably than most people typically do. I think my stance on it is the point of venture is getting as high returns as possible. Like that's the only point of being in this asset class. So that probably means you need a more concentrated portfolio than not. And I think your view on it is a little bit different. What's kind of your view? And I think this is what the papers show in theory too.
Yeah, the question is essentially like what do your LPs want? Do they want that you get an 8x fund, and then your next is a 3x, and then your next is like a 1.5, and then your next is a 10x? Or do they want 4x, 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 4x? Like which is preferential? So that is going to depend a bit on the on the LP, of course. But I would say generally LPs would be happier if the GPs they invested in had good public market beating stable returns. Like I think that's pretty fair. If you accept that's the case, then like more diversification is almost a given because it's how you achieve that slightly narrow bander of returns, that slightly narrower band of returns, but still like above benchmarks, still like good, solid VC returns.
Does that beat the public markets, you think, a 4x? Like, I guess it depends on the time to liquidity on that, but...
Yeah, it depends a bit on the era. But even then, it's like, it gets very complicated with the maths because and like the theory. It's not that it makes a 4x more likely, it's that it makes 4x being your minimum more likely. You can still outperform it. Like if you're well diversified and you pick well, you can still do like a 10x fund in theory, or it starts to get difficult, but like you can still get great returns. It's more how it limits the chance of like complete failure. And if you look at the number of VC firms that completely fail, that should seem to be a priority to me.
Yeah, I think it's a little bit of too high of a number, the numbers that completely fail. Because I think the thing that I kind of, honestly, I hate about that chart from that study, it literally like, you cannot get above a 6x. Like I don't know where the cutoff is, but like there's like 0 samples, like 0 of n that hit anywhere above 6x. I'm like, that's like 6x is pretty good for venture, but like you want a shot at like a 10x, 20x, 30x. And if that chart should be, I think the chart that encapsulates that study should look differently, because I think that chart biases my head to be like, if there's no chance of getting a 10x, I don't think that's a good venture strategy. So, but to your point of like, yeah, if you're an LP, you want a relationship with a manager who will give you a very consistent strategy over a long period of time. So yeah, there's so much nuance on all this stuff.
There's a lot. Yeah, there's a ton. So like the chart itself, just to touch on that, like that's based on data that looks at what is the typical distribution of returns in VC. So it's kind of looking at like an average profile of returns and how do you use strategy to maximize that. So you can, like, for sure, like I said, you can definitely outperform that. You can do way better than that. It's just trying to understand based on strategy, like where is the average return likely to be? What's how does it influence the rate of complete failure versus the rate of success? So it's almost a distraction from the point because it leads people to make a lot of incorrect conclusions. The other like 2 little things I think are worth adding onto that is like research shows, generally speaking, a more diversified VC is more likely to take or is more comfortable taking more risk on a per investment basis. So they'll go out and back things that might seem crazy to other people more often. And a lot of the time, I think that can help accommodate more like real outliers in the portfolio. The other thing is like research on how like this idea of like you should have super conviction, you should be concentrated in your winners, and that's how you deliver outlier returns is true in theory, but research shows that like overconfidence is more of a negative than a positive, more or less. Like managers tend to have like a better perception of their own ability than is realistic, and when they therefore concentrate, they're more likely to do themselves harm than benefit, essentially.
What else do people tend to get wrong about portfolio construction? Like, is there anything else? Because portfolio construction is basically risk management, right? It's like, how do you control? It's like the thing you can't control. You can't control how well a company is going to do ultimately at the end of the day as an investor. Like, it's on the team. It's on the founders. You can have like a 0.1% impact, but you can control your own portfolio construction and risk management. So what is another thing people tend to get wrong?
Probably the 2 we've covered, I think, are like the biggest ones. One is diversification and the other is reserves and follow-ons. Outside of that, I mean, like probably there's something to how VCs think about diversification, not just in like number of portfolio companies, but in exposure to particular themes. Because if you're entirely in crypto and then the bottom falls out of crypto, your whole fund is toast. But if you're a generalist and you're like a little bit of crypto, a little bit of consumer, a little bit of enterprise SaaS,
got some biotech, whatever, deep tech space.
for sure. Like you're more robust, basically.
Have you seen those studies that specialist versus generalist, like which outperform? What's the data show on those? I feel like I've seen some data, but I'm wondering what your opinion is.
There's been a few studies. Some of them, this is an interesting question that gets into like good data versus bad data, which is, I know, something we were going to talk about. This question of specialist versus generalist is one of those questions that has like been in VC for decades and decades. Similar to like the question of persistence. Does VC performance last over time? So both of these questions have a ton of data, a ton of studies. I tend to bias towards looking at the more recent data because to the extent that VC has changed a little bit, like, you know, it's probably worth looking at the most recent findings and maybe they're the most indicative. So on the question of specialist versus generalist, the most recent research that I know of was PitchBook, I think a year or two ago. And they found basically broadly generalists outperform for basically the reason we just described. Like they can cover a ton of different themes. They're not tied to a particular theme through their LP agreement. So if something really interesting happens in like year 2 of deployment or year 3, they can get into it. The exception is fields where there's like real, like hard science, like life sciences.
Like some kind of expertise that's needed.
Yeah, if you need real like deep scientific expertise to understand a company in a field at all, then yeah.
Like a blood testing startup. It's like, does this blood testing actually work? Yes or no?
Well, you say that, but that was like diligenced out by Google Ventures in a simple little test they did. But yeah, you know, it's a good point all the same.
I think another lens I've seen on that with, I'm piling on to your, because you just supported my narrative of being more of a generalist investor, but it seems like specialist funds will outperform early in like a sector or like an area of specialization, and then that kind of gets like competed out. So an example might be like crypto Web3. Let's say it was like a crypto fund in 2019, 2020, you're deploying, it's less consensus. But then if you're still doing crypto only in 2022 and all your entry prices are when that is a consensus thing, you kind of match the generalist returns. Like you no longer get that sort of like out of favor return. So I think specialist funds make more sense in a sector or in an area of specialization that are not within the realm of a generalist necessarily.
Yeah. It kind of depends on like, you have to be specialized in an area that is like has amazing and pretty immediate potential that few other firms have realized. Like, and if you can make those judgments, like you're in the right profession.
But then it's like, okay, that gets competed out and you don't have an advantage anymore as a specialist. So you need to have some kind of like truly defensible institutional advantage within that area of specialization that like continues to give you an attractive entry price and reason to win against maybe the more generalists. So I don't know. I think it can work both ways, but
I think, to be honest, the almost like with the exception of the life sciences stuff, just be a generalist. And like if you have a thesis like on the side, like we're a generalist fund, but you know, at this point in history, we think there's an outsized opportunity in biotech. Then like you can just start investing a little bit more in biotech. You don't need to build a whole fund around it. And I think that is, you know, from a kind of basic perspective of understanding outliers and venture capital and recognizing that the greatest companies are generally not from well understood sectors, like it just kind of makes sense to me that like that's how you should be.
Yeah, I think my friend Rex Woodbury had an interesting post about this, and it was kind of a chart. You may be seeing this table. It was like years, and then it was like most valuable company founded in that year, and then it was like hottest sector at the time during that year. Or maybe some of those rows and columns are switched. But it is basically just showing like in every year, the most valuable company that was started was not in whatever the current thing was. And so I don't think you should just say like, oh, AI is super hot. I am not investing in AI just because of that. But it's like data that shows like, it kind of goes back to that point of like, if you want to actually generate returns, you need to make sure entry prices are attractive. So, but then it's like velocity of dollars deployed. How much capital could you move? You probably should just invest in the stuff that's moving the fastest, even if it's overvalued. So
it depends. Yeah. Are you an investor or a trader?
Yeah.
That's the question.
Yeah,
are you chasing ultimate outcomes or the proxy metrics that let you raise another fund? It's the core of all of this, really.
Okay, so maybe moving to a slightly different topic, but what do you think is the correct way to value a startup? And you do a lot of it through Equidam. Like, how should I think about valuing a startup?
That's a deep question. So, like, going back to what we were talking about towards the beginning, like a lot of VC uses relative value as a way to understand like how to price a company or like how promising an investment is. And it has all those issues we discussed around catering, and like it channels capital towards like areas of consensus, let's say. So the flip side to that, obviously, is if you are in the camp of what I would describe as like real VCs doing origination, you need to you have to have a lens on what is the fundamental value of a company. And that means you have to understand like what is the future cash generating potential of the company, which is obviously a ridiculously difficult question to ask at like pre-seed.
I mean, it's one of those things like you can't answer it. Like you can't say, hey, there's like these two people. What's the free cash flow going to look like in year 12?
Yeah, it's true. But you also can answer it because like this gets really, really deep into the theory, but essentially like you have to understand a few different things as the foundation. One of which is like valuation is always based on the future. It's like a hurdle for future performance. It's not a reward for past performance. The other one is it's always an opinion. Like there is no calculation in the world that tells you the real value of a company. It's always an opinion.
When you look at public markets, it changes every day. Every stock price changes pretty much every day. The price changes of every stock.
Yeah, because they're based on like what do people believe, basically.
Yeah.
So then the question becomes, like you look at a company at pre-seed, you can see the market they're going after, you can see the product, you can maybe see like what existing solution are they displacing, what budgets does that allow this company to tap into. You can think about like how much competition is there in the market, how much better is this solution than incumbents, and that tells you a little bit about what their moats might be, which allow them to preserve the margins over time. And basically you look at all of this and you can make a more or less like a gut judgment of like, does this company, like the way I always put it is like, can it unlock a ton of economic energy? Can it tap into something that like has a huge amount of cash waiting to be deployed into a better solution or like a different way to do things? And is that going to sustain over time? Are they going to be able to keep an edge over the market to let them like be to create a monopoly more or less? And I think you can make those judgments at pre-seed. And not only can you, but like that's kind of the job. Like if you care about the ultimate exit and not the incremental metrics, to go back to that point again, like that's kind of the job, I'd say.
Yeah, that's almost like the role of the founders is to figure out the execution of getting there. And you can help maybe. Most good investors probably help in some capacity, but really just gauging like, is this even possible? Like, is this an opportunity that I want to, allocate my capital to, I guess, with my crystal ball in a way. I like that framing of like market potential. I think a lot about just like customers. Like, do I think that you can generate a lot of cash flow from these customers? Like, do I like a company servicing this customer base? Like I have one that I'm looking at right now. Really interesting idea, but I'm just like, I just don't think you can make enough money on this. Like, I just don't think this is a customer that I want to go after. And it's just tricky because like they might be able to actually expand the scope of what it is, but I just don't think I don't think they will be able to. I don't know. It's but I think a lot about like customer base. Do I like going after this customer, and do I think you can generate a lot of economic profit serving this customer or serving this market? To your point,
and every VC, or like let's say maybe like 99% of VCs, probably 99.9, would say that like a DCF, a discounted cash flow model of valuation, where you model out like the future revenue, the future costs, you get to like the future free cash flow, and you use that to determine the value today. They would all say like that has no place in venture capital. Like there's way too much uncertainty. It's not practical. You can't do that for a pre-revenue company. It's ridiculous. But actually, what you do when you think about whether or not to invest in a company is basically like a simple mental DCF. The only benefit of like putting it out in a spreadsheet, if you need to, is you can pick apart the assumptions. Like, are you really going to grow at this rate? Is this really going to be your margin? And it's not to get to like a precise calculation, but to explore like what are the assumptions in the opinion.
My general super lazy, just like gut check initially is just you just assume something's like 10x revenue is like your exit multiple or whatever. Sometimes it's lower than that. Sometimes it's higher, but it's like, okay, if it's like a tech company, like growing at a relatively fast pace, outsized margins, like 10x revenue at exit is probably like semi-reasonable. Hopefully it's higher. I think you want that like uncertainty of like, ooh, 22x revenue multiple, whatever. But like, I feel like you start to get in trouble though, where you go in and you say, like let's say you invested at 100x revenue multiple and you're going to exit at 10. You need to grow 10x to then keep your valuation flat at a 10x multiple. So I like to think, okay, if I'm only investing at a 50x, that cut in half the return expectations. You only have to grow 5x. Or if you come in at a 20x, you only have to double to hit that same exit valuation. And if you 10x, then you got a 5x increase in valuation at the exit, if all things kind of hold true. So to your point about almost like re-risking the business, I kind of think about that a little bit when I'm just generally thinking about this is like, how high is that hurdle that I'm coming in at, that the founders are giving themselves? And then in the context of like the full portfolio of like a basket of all of these, how is it kind of going to all culminate when it all kind of gets said and done in 5 to 15 years when some of this stuff really starts to play out?
And a big part of that is like the multiple drops over time as the growth of the company slows, as it matures, like for sure. But also as you go from like pre-seed to like a public market company, the quality of your revenue matters a lot more. And that if you're like investing on like an ARR multiple basis, it's kind of the point I made earlier about like gap accounting and like adjusting to that life. For how long in a company's life can it be valued on ARR and invested on that basis and still be able to like do a hard like handbrake turn at the end and become like a reasonably healthy company in a public market or in an acquisition scenario? Because those buyers do care. It obviously created like a ton of problems with SaaS companies in 22 because they could not turn around that quick.
Yeah, one thing I think too, when you look at just generally public market, I feel like you need to use public markets for this because there's not private market data on what drives returns. But I think generally in public markets, you'll see them. I forget the numbers, but like the majority of returns are basically driven from multiple expansion and earnings growth. So if you say in venture, you're typically fighting against multiple expansion. Like you're probably going to get multiple compression. But like the holy grail is, can you actually get multiple expansion on top of earnings growth? And that's maybe when you look at like 100 baggers in the public markets, that typically happens. It's like you bought a company for 4x earnings and now it trades at 20x earnings, and they grew 100x, and now it's become this like, compounding, durable, sustainable growth, and the market knows. And that's why it trades at 20x earnings, but it was trading at 4x before. And you bought it at 20 million in earnings. So you bought it at like a $100 million market cap, and now it's worth $6 billion because you expand your multiple X amount and you also grew earnings by X amount. I kind of talk to like a lot of my public market friends and be like, oh, this venture is kind of like, it's like micro cap penny stock investing almost, where like, yeah, like if you go look at a public company that's worth $12 million, it's probably worth zero. But like you're trying to find that diamond in the rough of like, this is a 300 bagger, or like this is an $8 billion company that you invested in at 12 million market cap or something like that. And it's like treasure hunting. You're just going through, you're trying to find undercover gems really at the end of the day, finding founders. But it's kind of cool because in venture, they come to you. Like if you're a public market microcap investor, you're probably not getting these companies emailing you. And if they are, it's probably pretty bad, right? But in venture, it's like they're coming to you to seek out capital. So it's, it's kind of like this weird treasure hunting.
Well, that again, like it kind of depends on your strategy, right? Like the whole origination question. Are you relying on inbound? Like how good is your process for screening inbound? Are you relying on referred deals? Are you going out like hitting college campuses and hackathons? It's a pretty deep question.
There's this one study that you brought up that I think you posted about this on Twitter kind of recently, which kind of sounds non-intuitive, but generally speaking, investment firms that are located in popular startup hubs typically outperform the investment firms that are outside of popular startup hubs, but not necessarily on a company by company basis. Like just generally, like company based outside of San Francisco might actually outperform in San Francisco. Like how is that even possible? Like how does that kind of play out, and why is that in the data?
Yeah, it is a fascinating bit of research, and like the bottom line that I hope VCs take away from that is that they should be looking at opportunities in non-traditional hubs, because like they're great and they are out there. But essentially, like I think it's driven by the friction for like a Silicon Valley VC to go and invest in a company in Ohio is very high. So they're only going to make the effort if they think it's like really an outstanding opportunity. And also at the same time, because they're a Silicon Valley VC, maybe with like a big name, they can win that deal over any local investor. And also probably they have an easier time raising from LPs than like the Ohio VC does. So they have basically a lower cost of capital. They can invest on more favorable terms. They basically have all the advantages and the ability to pick opportunistically, whereas the local VC is a bit more limited.
Yeah, because I feel like that's generally what I kind of see. It's like if you're the best company in Cincinnati, Ohio, you're going to want to raise money from the best investors. Like you're going to be seeking out, though, you want A16Z involved. You want their great brand. Like they will talk about you on podcasts. You'll get the news mentions. You'll get Twitter threads about you. You'll show up in all the reports. People will know that you exist. And you're not going to get that from, I don't know, Midwest Ohio Venture Capital Fund, but I don't even know where I think Cincinnati's in the South. Have you ever been to Ohio? Because you live in Wales, right?
Yes, I do, and I've never been to Ohio.
Okay, have you ever been to the U.S.?
Yeah, I've been to. I spent about 6 months living in Miami, and I've visited other parts, mostly kind of West Coast.
Oh, interesting. Okay, because I think you in that one paper specifically, it talks about how proximity to portfolio company has no correlation to returns, or maybe there's like a negative correlation. I forget which one it was, but it's kind of non-intuitive because you'd think like, oh, if you invest in the thing down the street, you can like monitor it and check in and add value way better than if it's, a 20-hour plane ride away.
Yeah, I guess whatever that adds in terms of friction is kind of like priced in, like so you therefore would only do a deal if it was like really seen as worth it.
Interesting. Okay. And there's another study that shows actually that it's kind of related about founding team, and like the sort of like the quality of the founders is not actually a predictor of investment success. It's much more about the actual initial quality of the business. But a lot of times there's kind of like no business, I guess. Like, we were like they're investing in a team. So how do you what is that study that kind of shows like the actual business quality predicts And then like, how does that actually play out in sort of this like origination stage venture when there's not really a business yet?
There's 3 papers I can think of that have all found basically the same thing. I think that the best of which is called Predictably Bad Investments in Venture Capital. And they basically all look at like, what are the standard founder attributes that VCs pattern match for? And it's stuff like where they went to school, where they worked before, maybe like socioeconomic background. Do they go to the same squash club or something? Like a lot of very weird, like slightly tangential attributes that end up influencing VC behavior and investment decisions, but probably shouldn't in theory. And when you look at the data, like clearly shouldn't, like have quite a negative influence. Not only do they lead to like bad investments, but they lead to missed good investments, which is a huge problem. There was a second part to your question. I can't remember what it was then.
Well, that actually the quality of the business is what actually predicts the outcome, not the founders.
Yeah, and how you understand that at a very early stage.
But like, yeah, if you're investing in like there's no customers yet, how do you get business quality? Is it like potential business quality or something? Or like
there's a quote from Peter Thiel. He was asked a very similar question, like, do you focus on founders entirely? Like, what else can you look at the early stage? And his answer was, it's a complicated package. Like, you have to look at the whole thing. So in order, like, obviously pre-seed, pre-product, all you can really look at is the founders, but you can understand the quality of the founders and the competence through the lens of like how they articulate the idea, how they think about the markets. Do they understand like the financial side of things? Do they understand, the growth, technical aspects? So it's very easy for a lot of early stage VCs to say like, all we care about is the best founders. We don't care about ideas or we don't care about markets. But actually, that just means like you're kind of ignoring information that could be useful. Because even if it's the wrong market, even if they end up pivoting the idea, the way they talk about it and understand it and articulate it is like still really useful information.
Yeah. And it's sort of like, how did you come to your idea? What kind of research did you do? What was your process like? I have one portfolio company that when I invested, they had one idea that I thought was really good, well researched. They ended up pivoting, and the reason I invested was because I thought, I bet if they change concepts, they have a good framework for doing this. Like I trust them with the capital. I trust that they'll be able to do something. And yeah, they just kind of like pinpointed this almost like perfect storm, perfect category. Like it's turning out to be a really interesting business, still pretty early. But it's like one of those things I'm like, damn, that was like incredible pick. How the fuck did they find this? Like, it's also right in front of you kind of a thing. So, but yeah, it was like, I feel like that's definitely a good way to think about it. It's just like the founder ideation quality, discovery quality, understanding of like what it takes to go into, almost like Porter's 5 forces or like the 7 powers type equation of when you're starting a company, what are the ideas to pursue related to margin structure and dynamics in an industry and how those could change over time based on new technology.
Yeah, and you have to reconcile that with the fact that like other research I've shared shows that like high-tech startups are actually more likely to succeed after they've had at least one pivot. Or after they've had one pivot. It goes like down a bit after that, but like one pivot is actually a positive, which is crazy because it means everything you think you know about the business at the first pitch meeting is like probably going to be wrong if it's a good company.
So what is considered a pivot in that time? Is it like we're a consumer social media app and now we're like a B2B AI vertical SaaS thing? Like, how do you define like a pivot in that one good pivot thing?
It's a good question. I can't remember how the paper described it off the top of my head, but it was like a pretty fundamental shift in the direction of the business. So it was like significant.
Yeah, because when I think about every single, probably like half of my investments I made are just like pre-customer investment. Sometimes they're pre-product. Sometimes like they're working on getting customers or like in the discovery phase or whatever. But pretty much every single one of those, the thing that was in the pitch deck is like the main kind of product that was going to be, used to generate the business revenue is not true anymore. There's a lot of cases where like generally like the customer space or like the general idea, but like the way they actually solved it, just completely different than the pitch deck. Like the pitch deck was just kind of wrong, right? But it's sort of this discovery process of meeting the team and like you're almost like sussing out their ability to go execute on this and figure it out really, because it's kind of an experiment. It's an adventure, right? Like you're figuring this all out.
And that like ties into a few things we've talked about. Also, like maybe another paper I would recommend, which is Premature Scaling by Startup Genome. So this like ties together a few of the topics quite nicely. They looked at, well, like basically they were trying to study like what are the main causes of failure in startups. And they were surprised by their own finding, which was that I think in 70% of the failures they looked at, a significant problem of the company was that they'd raised too much money. And essentially what that meant was before the startup had like properly validated what they were working on, that they had like product market fit and it was the right direction for the company, they raised a ton of money and invested a ton of money in growth and in hiring and technology and development. And then when it was wrong, like the company just explodes. Whereas if you go like piecemeal, step by step, get the very small checks from a nice, small, friendly, originating VC fund, you can work that stuff out as you go and you have a partner to kind of help you through that. So like the parallel there on the other side is maybe like the mega fund VC who would give you the huge bag of cash in the beginning and then just kind of stand back and like maybe you take off and it's amazing, but quite possibly you explode. And maybe they're okay with that trade-off. Maybe that's like built into the maths of their model.
Yeah, I would think so. Does the explosion or the failure happen because you set a super high bar of what the company needs to hit in terms of like the valuation of metrics to reach that valuation, and you're just unable to raise more capital and you run out of money? Is that generally why the kind of explosion or the implosion happens?
Yeah, basically you have like a very fragile future. Like the thing that you pitched them on that they invested a ton of money in, it has to work and it has to scale quickly. And if it doesn't, you're done because the bar, like the hurdle for that next round is now so high, you just can't clear it.
Interesting. Yeah, and it's if you just think about a $10 million fund that writes a $100K check, that's 1% of their fund. $100 million fund that writes $1 million check, 1% of their fund. $1 billion fund that writes a $10 million check is also 1% of their fund. So in all those cases, if I invest a $10 million fund, 100K, it's like if it doesn't work, it doesn't work. Like that can drive my returns. But I was like, hey, that's okay. Like you guys tried. Like doesn't screw. Like there's a reason I have a fund. Let's say I wrote 100 checks of 100K each. It's fine. For a fund that's $1 billion, wrote $10 million check, didn't work. You're like, that's fine. Like we tried. We tried to get to the Series A that we wanted to put 3% of the fund into. Didn't work. Whatever. Like it's not a big deal. So I think as a founder, if you're trying to play that game, I would say you got to find more funds that you can find that very small percentage of the fund option check. They're there, right? Like we see it. I have portfolio companies that have done that have been like $10 million kind of option check from a big pool of capital to keep it going. Sometimes it works, sometimes it doesn't work. So, but it's an option there for founders.
The question that it kind of leaves me with is the mega funds, when they start doing origination themselves, like how well set up are they for that? Or like, do they even have like slightly different incentives? Like if they're doing this strategy of like trying to ride the waves and like trying to produce like essentially like venture beta rather than alpha, do they necessarily care about finding the crazy little outliers? Perhaps that's not how they're oriented. And that kind of shows in the data where they actually seem to be increasingly concentrated in like San Francisco software companies rather than branching out as they get bigger. So yeah, I have lingering questions about that and their involvement at the very early stages.
Yeah, I mean, ultimately their business model is put a bunch of capital into only a couple companies. And you can't put a bunch of capital at the origination stage. You need them to get further along. Like you're probably on a cost weighted basis. Like let's say one of these mega funds fully plays out and you just look at like, we're talking in 2040, we're looking at what they were doing in 2025. I mean, their average entry point on dollars is probably like a Series B or maybe even a Series C, because it's like 5 million at the seed, 10 million at the A, 20, 50. They might put 100 million in right before an IPO. So like your average cost basis was like almost at the IPO, really, at the end of the day. But you basically use that origination check as a right to get there, to get into that company. So,
and actually you want it to like whittle down. Like you want to start with whatever they're doing, like 100 seed checks a year. And you want that to be like 2 companies by the end to concentrate all the rest of the money into.
Yeah, because you want to make as much money as possible while doing as little work as possible as an investor, right? Like you want to give someone, you want to give them cash. A year later, they give you 100x of it back, and you did nothing. That is probably for an investor. That is like the most ideal. No one will admit that publicly, but I mean that's ultimately what every investor is going for. So we first connected on Twitter a couple years ago. I don't know. I just feel like I've been reading your stuff for a while. We've kind of talked back and forth. How did you kind of first get started with writing?
So like my blog, which has the very like unusual name of creditstick.com, which is a Shadowrun reference. Unfortunately, a misspelled Shadowrun reference for anyone out there.
Shadowrun, is that a game?
Yeah. It's like originally like a tabletop RPG, but became video games later on.
Yeah. Did you play the video game?
Yes.
Oh, so this is the one where it was a gun game. It was shooting, but there was magic.
Kind of, yeah. It's like a isometric turn-based kind of setup. But it's basically it's a connection to like science fiction, which is what I originally intended to start writing about, the intersection of science fiction and technology today. That led into writing about like Web3, metaverse, because I was like super interested in that. I'm a big fan of books like Otherland by Tad Williams, Permutation City by Greg Eisen, Neuromancer, of course. Like they all have kind of connections to this. And then Web3 turned up and I was like, oh, this is amazing. So I started writing about it. And I quickly realized the people investing in Web3 didn't have any familiarity with the science fiction, the literature about it, with like existing virtual worlds. They didn't know about like Second Life. They didn't understand World of Warcraft. I needed the research on these topics. Like so much interesting stuff was out there to be like a very useful resource that wasn't being applied to this like wave of like metaverse and Web3 companies. And that's when like my writing took a pretty hard turn into being like, hey, venture capital is kind of broken.
Okay. What were the name of those 3 books? I'm going to throw a link into the show notes for people.
The first is a series of 4 books by Tad Williams called The Otherland books, the Otherland tetralogy. The second was Permutation City by Greg Eisen. And the third was Neuromancer by William Gibson. And there's also, there's a ton of others you could mention in that same kind of genre, but like those are the 3 I think about the most when I'm like, it's like near future sci-fi that is still relatable. So if you're a VC and you're thinking like, what's the world going to be like in 10, 15 years? I think those are good books to read and think about.
What are the general takeaways in terms of what's the world going to look like? Like, is it not Web3? Everything's tokenized? Is it more of like virtual economy? What's a way to think about it?
I'd say like Neuromancer is interesting because it's kind of like, it's cyberpunk, so it's dystopian. It's like what would happen if like the FTC didn't exist and corporations were allowed to do whatever they want.
No, that's basically today, right?
Kind of. Almost. Like you can see the direction of travel a little bit.
Did you see We'll throw the picture up on the screen. I think Trump like posted a picture. It was like an AI generated picture of him looking at a computer that just said Intel $30, like buy Intel stock or something. Did you see this?
I didn't. I missed that.
Oh man, I'll send it to you right after this. But it's so funny. It's like, what are we doing? Why are we allowed to do this? This should not be allowed.
It's crazy. It's great with like, neuromancy kind of gives you a lens of like what the worst end state of that would be. Also with some fun stuff like human augmentation, biohacking sprinkled in. Otherland is like really quite literally like what the metaverse should or could be like. And this is like with like brain interfaces, like AR, VR, like all this like future visions of like current technologies, which is really interesting. And it's not set too far into the future, so it's like quite attainable relatively. And then Permutation City, I think, is more like what science could look like in the near future, like biology particularly as well.
Interesting. Yeah, I'll throw links to all those in the show notes if people want to check them out.
I should start like a VC sci-fi book club because I could talk about that endlessly.
Yeah, you should. I feel like people appreciate that kind of stuff. Any advice for someone who is kind of starting to think about writing online? I'm assuming you probably did a lot of not online writing before this. Is there like a transition that you kind of went through or made, or like a change in mindset?
It's maybe tricky. Like there's a kind of a leap you have to make. Like when you go from just like posting on X and being in the timeline with hot takes on topics to when you start being like, okay, I'm going to have a blog or a Substack. And the transition is like what I write is no longer really ephemeral. I'm kind of like carving it somewhere. So you have to be comfortable being like, this piece of writing is kind of like a part of me or a representation of me, my view on the world in a certain way. You have to be willing to be wrong or to look dumb, to have people like send you comments or DMs and be like, here's 500 words about why you couldn't have a more idiotic take on this topic. And maybe they're right, maybe they're wrong. Maybe it changes your opinion or, you end up rewriting something. But that's like has to be part of the process, because the alternative is you do what most VCs do, unfortunately, which is rewrite the same perspective on the market that everybody else is saying that adds zero insight.
Valuations are too high. Mega funds are bad. Whatever. AI is going to change the world.
Yeah. Why whatever my portfolio is mostly invested in is the best opportunity right now.
Yeah, exactly. That's good. You should write about that if you're a VC. Go for it. I'm not going to stop you. What was the most bold cold email you've ever written?
That would be by like quite a wide margin. A few years ago, I was working at a media company in Berlin. We were focused on like data science, machine learning, more or less what you would call AI today, but people didn't back then. And I was trying, it's a media company, it's a grind, it's horrible. You're trying to do anything you can to get page views. And I saw like Mark Cuban had this new app. So I just sent Mark Cuban an email and I was like, hey, Mark, can I interview you about this app launch? And he replied like 30 minutes later and said, sure. I had a 0.1% chance in my head that he would even see the email, but it was pretty amazing. It taught me like from then on, you got to take those shots because there's no cost. There's no downside. You might as well. And it can have big payoff.
I actually, dude, I've heard Mark Cuban responds to a lot of stuff. Like I've heard so many people say they've emailed me to respond. He once retweeted a couple months ago, he retweeted a clip from the podcast on the Twitter account. And I was like, oh, was not expecting Mark Cuban to see this and retweet it. So I DM'd him just like, hey, want to come on the podcast sometime? So we're trying to figure it out. I probably have to fly to Dallas and do it with him in person, or maybe I can get him to do it virtually. He actually has a surprising amount of podcasts, and it's hilarious because if you look at his background, it's like the messiest office with just shit everywhere. Just YouTube Mark Cuban and just scroll and look at his YouTube thumbnails on YouTube. You could tell he does not care.
Quite often with like NBA trophies, if I remember correctly.
Yeah, there's just random stuff. Like you can tell that it's just a guy's office. It's a 55-year-old dude's or 60-year-old dude's office who's like, he's just got stuff going on. There's stacks of papers. There's like snowboards or like football, basketballs, and like, yeah, trophies, massive stacks of papers and binders. And yeah, but anyways, well, this was a lot of fun. Thanks for coming on the show.
I really enjoyed it. I would do this, any time, all the time. You'd have a hard time getting me to shut up, but I really enjoyed it.
Actually, before we sign off, what's a good way for people to follow you? Twitter seems to be probably your main channel. You got a blog too, where you write sometimes. What are those?
Yeah, I pretty much everything on Twitter, to be honest. It's like my goal with all my writing is to put it in the most accessible place. So that, for the time being, seems like Twitter.
Yeah. Okay, cool. Yeah, we'll throw links to those in the show notes so people can find them. Well, cool. This is a lot of fun. Thanks again for doing it.
Thank you for having me. It was great.
And thank you for listening. And thanks to Ramp and Harmonic for supporting this episode. Head to ramp.com/thepeel for $250 on your first set of cards, and harmonic.ai/Turner to check out their AI startup scouting tools. If you like this conversation, check out the back catalog of over 100 episodes, including last week's with Dan Fader, who runs private market investing at the University of Michigan's $8 billion portfolio. If you want to help me out, please like, comment, subscribe, and name your next venture capital research paper after me. And if you don't want to miss a future episode, subscribe to our newsletter, The Split, linked in the description to get each episode plus the transcript emailed directly to your inbox every week. Thanks again for listening. See you next time.